Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the upcoming CPI data that we should get a bit later this week and the potential implications on the Fed funds rate in the November meeting. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the Into the Cryptoverse newsletter, which you can find a link to in the description below and in the pinned comment. A reminder that every single month we do pick one person at random to get a free month subscription to ITC, which includes this chart and a lot of the other charts you see me talking about while I make videos. So make sure you check it out. Links down below. Now, inflation, headline inflation year over year, came in at 8.3% last month. Core inflation came in at about 6.3% last month. Now, I will remind you, if we just briefly go take a look, core inflation last month 6.3, but the month before that was 5.9. So the peak so far on core inflation occurred in March at 6.5%. Now, if the consensus is right, which to be completely honest, they don't really have a great track record, but if the consensus is right and we come in at 6.5%, this is going to be on par with what we saw earlier this year. It's interesting in some regards because this, if you, especially if you follow the Cryptoverse stuff, this cycle has been full of like double peaks, right? You saw a double peak on Bitcoin, right? We saw that. We have sort of the double Bitcoin peak one and peak two. It's possible that we're seeing something similarly play out with inflation, right? Like a double peak where it maybe goes, core inflation goes back up to some of these higher levels that we previously saw before ultimately coming back down. One thing I want to draw your attention to as we continue to track inflation and more, core inflation I think is more important for what the Fed is interested in. But if you go look at headline inflation, the consensus estimate is 8.1%. Now, that was the estimate last month as well, and it actually came in at 8.3. But one thing that is worthwhile to follow is that oil has actually been moving up a little bit recently. Okay. I mean, this was a fairly brutal move down by oil in a relatively short period of time, but you can see most recently it's actually broken back out to the upside. Now, if oil continues sort of this path of slowly going back up, this is just simply going to renew inflation fears. And this could also lead to or to headline inflation remaining a bit stickier than people might want it. One of the main reasons that headline inflation came down was because of how quickly the price of oil came down. This was a big component of it. But if oil starts to go back up, then some of the downward pressure on headline inflation may no longer be there. Now, one argument that for oil is that it should eventually go down if in fact we do get a fairly deep recession, which to be honest, it does seem like the Fed is trying to engineer. I mean, I know they talk about a soft landing and whatnot, but raising rates this quickly into a slowing economy just seems like we will eventually get that recession. Again, you could argue we're already in one based on 2 consecutive quarters of negative GDP, but based on the unemployment rate, it still hasn't gone up. And in fact, last month it went back down to the historical low this business cycle, back down to 3.5%. So this is an important consideration that, hey, oil might eventually go back down once we actually get to a recession, a deep recession. But in the short term, it could certainly it might not go down straight away, I guess is one way to think about it. So if that ultimately happens, one of the things that I think is worthwhile to look at is whenever we have periods of high inflation, we typically see a recession where unemployment is going up. You can see after these recessionary periods in the 70s, or inflationary periods in the 70s, we had recessions around them. And now that we have high inflation, I would expect eventually we will hit a recession just like we also did in the 40s a couple of times. So, like 2 periods of high inflation, we got a recession after both of them. In the 70s and 80s, right? Every time inflation came up, right, we ended up getting a recession. Even in like the early 90s, even when inflation kind of gets up to 5% or so, it still typically leads to a recession. Now, obviously, what was going on during the financial crisis is a bit different and a lot more complicated than just saying inflation's up. But you can see, generally speaking, that when inflation goes up, we normally see a recession where the unemployment rate is going up as well. So I just want you to take make sure you you follow this, because it certainly will have an effect on markets. Again, going back to the core inflation rate, if it comes in at 6.5%, that is generally the consensus at this point. But the problem is that this is not going in the direction that the Fed wants. Okay, so with the information that we have now, with the information that markets have right now, they are estimating that at the November meeting, we're going to see there's a 78.1% chance as of right now that it'll be another 75 basis point rate hike, and only a 21.9% chance of a 50 basis point rate hike. So if it's a 50 basis point rate hike, it'll get the Fed funds rate up to 3.75%. If it's a 75 basis point rate hike, we get up to 4%. Now, I would expect to see some changes in these two percentages this week. Okay, the reason is because we are getting CPI data out on October 13th, I believe it is. October 13th. So we're getting more CPI data on October 13th. I would expect this to change. This looks somewhat similar last month, right? It looks somewhat similar when we had the last CPI data, about a small percentage of a 50 basis point rate hike and then a larger percentage of a 75 basis point. After we got that inflation data, what happened? The 50 basis point rate hike probability went down to 0. This stayed about the same at 75, and then we had about maybe a 20% chance of a 100 basis point rate hike. So if CPI data comes in hotter than expected, let's say it's accelerating again or still accelerating, then I would expect to see this shift a bit, where it's maybe a small percentage of a 100 basis point rate hike and maybe a 70-80% chance of a 50 or a 75 basis point rate hike. If on the other hand it comes in cooler than expected, I don't think that a 50 basis point rate hike probability is necessarily going to go up to 80% this week, although it could, but it might get more, say, 50-50. Okay, and if inflation data comes in with general expectations, then this might not change that much. But these are important considerations. Again, as long as the Fed continues to raise interest rates, it is going to sort of be this, this like thorn that continues to put downward pressure on the stock market, because the economy will be feeling it, right? And the stock market will sort of be anticipating that the economy will feel it. I mean, again, it takes about 12 months for some of these interest rate hikes to really filter through the entire system. But of course, the stock market, as always, is forward-looking, and we'll start to begin to really anticipate how will all these rate hikes affect risk assets as we get out into 2023, and once an actual recession is likely declared. So just wanted to talk about this a little bit as we head into the week. I don't really know exactly what price action is going to do in the short term. I would expect a lot of volatility on the day of the CPI data. There always is a lot of volatility, but more importantly, let's see where this ends up at the end of it, and what the probability is of a 50 basis point rate hike and a 75 basis point rate hike. And if you remember back to one of Powell's recent speeches at the last FOMC meeting, he talked about how markets were sort of debating whether they were going to raise 100 basis points or 125 basis points. And at this point, it seems more likely that it'll be 125 basis points, because if you go look at, about an 80% chance of a 75 basis point rate hike, but currently the Fed funds rate is 3.25%. Okay, 3.25%. So if it's only going to go up 100 basis points by the end of the year, that'd be 4.25%. But you can see that by the December meeting, there's only about a 15 to 16% chance right now that the market thinks it's only going to be 100 basis points between now and then. So it's a lot more likely right now that we get 125 basis points over the next two meetings to get us to a Fed funds rate of 4.5% by the end of the year. And there's also a smaller chance that there is going to be, another 75 basis point rate hike in December, which could get us to up to 4.75%. So a 23% chance that we get another 150 basis point rate hike between now and the end of the year. But of course, the most likely scenario is 4.5% at the end of the year. Hopefully this video is at least somewhat insightful. I just wanted to talk about sort of the expectations going into some of the CPI data, what to watch for. Oil these recent oil prices are probably not going to have a huge effect immediately, just because this is a recent move, right? You can see this move really started at the end of September, but this move could certainly, especially if it continues, it could certainly affect headline inflation in, say, like November and December. If it just sort of comes back down now, then yeah, like it probably wouldn't have a large effect. But if you get some type of, secondary distribution phase on oil or something, then that would be something I think to take into consideration. If you guys like the content, make sure you subscribe again, give the video a thumbs up, and remember to check out the Into the Cryptoverse newsletter. You can find a link to that in the description below. We also do have Into the Cryptoverse Premium at intothecryptoverse.com. See you guys next time. Bye.